Hello everyone. Today I have come up with a very interesting topic, which is something related to the great George Soros. So these days you are hearing about George Soros talking about India, our Prime Minister Modi, then regarding the Adani stocks, etc. So I have been researching much about George Soros and his famous book, The Alchemy of Finance, since long. In fact, I had put a YouTube short regarding the Alchemy of Finance and how relevant it is for a stock market investor. So today I am going to decode the main aspects or the key concepts in George Soros' book named The Alchemy of Finance. So this book is a really tough nut to crack. It's really a tough read. So common people or a beginner investor may not be able to understand the language he has used in the book. I would say it's a high level language. In the sense, it's not about the English I'm talking about. It's about the depth of the content which he has utilized in the book. I have personally read this book at least 4 times to understand the entire concepts. So without delay, let's get into the subject. So the book name is Alchemy of Finance, Reading the Mind of the Market. So literally, the book is enabling a reader to understand the stock market. In that case, he is explaining about stock market, currency market, the credit debt cycle, etc. But today we'll be concentrating on the stock market aspects of the book. Mr. George Soros helps to decode the entire stock market, how it works, how the upward and downward trends of a stock happens, basically the boom and bust cycle. If you see the book, the part 1 and part 2 are only important for understanding the entire concepts. Rest portion of the book only explains about the various examples stating these concepts. In our economy, economists rely on equilibrium of financial market known as economical theory, and financial analyst seeks value. As per George Soros, both are wrong and are irrelevant. Now, for ease of understanding and for ease of communication, I will be talking as if I am George Soros, and the entire concepts in the book will be decoded as if I am George Soros. So please take it like that as you go further in this video. Please note that the concepts explained in this book and hence in this video is very complex and in-depth. So I will require your complete attention into this video till the end so that you understand the entire concept, and it will help you decode the entire stock market like the Neo in Matrix.
He is the one.
Economical theory is based on rational behavior based on the ideal world, and the participants in the same acts based on perfect knowledge, and relates to theoretical equilibrium based on optimum allocation of resources. The relationship between the participants' understanding and the situation in which they act or they participate is to be really understood. A theory can only be accepted and proven as long as repeated attempts are made to disprove or to prove the theory wrong, and those attempts are failed. But no economical or financial theories can be put to such rigorous real case testing, because in real world, unlike economical theory, things are based on imperfect understanding of its participants and are much beyond equilibrium. If you see in reality, the economic and financial markets does not exist without the decision and activities by the participants in the same. To state an example, just imagine a financial world, say Indian stock market, wherein RBI, basically the central bank, has its monetary policy, and the monetary policy makers and the RBI team doesn't think at all. So that is impossible, right? So they need to think, and they need to decide a interest rate, say for an example, as a part of monetary policy to control the inflation, etc. So they think, and the situation or the scenario is the financial market. So they think, or the economy. So they think, they take a decision, and this decision has an impact on the market fundamentals, and the participants reacts to that. So this book mainly explains about the theory of reflexivity, wherein Mr. George Soros explains about the role of the thinking participants. So the economical theory states that the market is always right. So the Mr. Market is always right thing. So it states that the market is always right, and all the future developments are discounted into the current market price in which the stock is quoting at, even if currently those future developments are unknown. But as per Soros, in reality, the market price are always wrong and is distorted. It provides a biased view of the future, which I also totally agree. In fact, I am presenting and taking efforts to present this book completely to you, since I read this book at least 4 times, and I totally agree to all the points mentioned by Mr. Soros in his book. Distortions act in both ways. Not only the market participants acts with a bias, but the biased view can impact the course of events as well. Future events are modeled by present expectations as well. Flawed perception of the market participants. Here the market participants are investors. So I will be always stating this as market participants. So you have to interpret it as investors. The flawed perception of the market participants and the future actual course of events has got a two-way connection, which leads to lack of correspondence between the two. This two-way connection is named as reflexivity. Sometimes reflexivity may not be there as well. Now Soros talks about theory of perfect competition. Under certain specified circumstances, the unrestrained pursuit of self-interest leads to optimum allocation of resources. So Soros again talks about the theory of perfect competition. Again, he states that this theory is completely flawed due to the following 2 reasons. It's assumed that the participants, the thinking participants, knows completely about the situation, but the reality is they don't know much of the situation. Only a partial portion of what is happening in the situation is only known to them. And also it's assumed that the participant knows the preferences and alternatives available for him to choose, but unfortunately the fact or the reality is that he is not aware of the complete alternatives or options available for him to choose. So we all know that the stock prices are based on the demand and supply for that stock, but this demand and supply is again dependent on the perception or thinking of the market participants, the investors. It's based on their expectations. So we can interpret that the stock market works on the expectations of the market participants, who are the investors. So if you see, the buy and sell decisions in the market is based on the future expectations of the investors. So if you further simplify, the buy and sell decisions in the stock market is based on the future prices which is expected by the market participants, who are the investors. But if you see, the future prices are again defined by the buy and sell decisions by the investors right now. So as I explained before, that demand and supply of the stock and hence the stock prices are dependent on the market influences, and market prices or the stock prices cease to be uniquely determined. So instead of an equilibrium, we are left out with a fluctuating price. So in such a case, if this is true, the economic theory is only theoretical and cannot be applied especially to a financial market, or else in that case a stock market. So I can confidently tell that market is not always right, it is always distorted and is faulty. We all investors, and also in case of traders, they know that the stock prices are hugely dependent on the market developments. Rising prices attracts buyers and falling prices attracts sellers. Self-reinforcing trends are developed based on this supply and demand in the market. You may try to defend the theory of perfect competition by arguing these trends we observe are in a short duration, and these short-term aberrations will be ruled out on a longer term based on the fundamental forces of the stock. But the issue is that there is no assurity that these fundamental forces will not be affected by the speculative thought process of the market participants on its fundamental value. It is always possible that the fundamental forces of supply and demand can always be distorted by the speculative or the perceptions of the investors about the stock. We investors always think that our thinking about the stock is always perfect, thinking that we know everything about the market and about the stock. But this is not right at all. As you know, the actual course of events most of the time tend to deviate from the investors or the participants' perception or expectations. These divergence can be taken as an indication of participants' bias. So this connection of participants' thinking and the situation in which they participate can be broken down into two main relationships. Participants' effort to understand the situation is named as the cognitive function or the passive function, and the impact of this thinking on the real world can be named as the participating function or the active function. So in the cognitive function, the participant's perception depends on the situation, and in the participating function, the situation is influenced by the participant's perception. So these two functions work in opposite direction. So if you see in the cognitive function, the independent variable is the situation, and in the participating function, the independent variable is the perception of the participants. Perception in the sense, participants' thinking. These functions can work independently, but many times they work at the same time as well. So when both the functions work at the same time, they interact with each other. This makes the situation complex. So if you go back to our fundamentals of mathematics, a function needs an independent variable to produce a determinant result. But if you see in this case, the independent value of one function is the dependent value of the another function. So instead of a determinant value, we have an interplay between both these functions, in which the situation and the participant's view are the dependent variables. This complex interaction, which I told earlier, is called the reflexivity, wherein the subject and object are the same. So if you see these two functions, the cognitive function and the participating function doesn't produce an equilibrium, unlike the economic theory, but produces a never-ending process of change. So by now you would have understood that if a situation has got thinking participants, then the sequence of events will not lead from facts to facts, but from facts to perception and perceptions to fact in a shoelace pattern. Thus this concept of reflexivity yields a shoelace theory of history. So it can be argued that in economic theory, the participant bias is leading to unattainable equilibrium. The target equilibrium keeps moving as the bias keeps changing. If you see in microeconomics, this bias created by the participants' thinking is negligible. But in financial market, that is the stock market, the distortions created by the participant bias are very severe. If you see, the participant bias is important for determining the stock price. If you see the market developments like rate hikes, inflation, recession, or Russia-Ukraine war, some fraud cases, etc., impacts the thinking capability of the investors, the participants. So this will create a bias. So the search for equilibrium is like a wild goose chase. So reflexivity in stock market has got two components, fundamentalist and technical. So fundamentalist is a outgrowth of economic theory only. So in the fundamentalist approach, it states that the current market price of the stock is different from the fundamental value of the stock, and the fundamental value of the stock is dependent on the earnings potential of the stock. Technical approach is based on the market trends, the demand and supply of the stock, and it helps predict the probabilities and not the actual course of events. So again, George Soros explains about the random walk theory. The random walk theory explains that the market fully discounts all the future developments so that the individual participants' chances of over or underperforming the market as a whole is even. But if you see, this theory is only applicable for just index funds. Because if you see, including George Soros and even my portfolio, I have overperformed the index over many years, and hence this random walk theory is only applicable for index funds. So if you see, as per the fundamentalist approach and also the technical approach, end of the day, the stock prices is supposed to finally follow the fundamental value of the stock over a period of time. The possibility of the stock market developments can affect the future prices of the stock price is completely neglected as per this analysis. So as I explained earlier, the theory of perfect competition, wherein it states that the market is always right, is completely opposed by George Soros, stating that the stock market valuations are always distorted based on the perceptions of the investors, and these distortions can affect the underlying values. So it is very important to note that the stock prices are not merely passive reflections. They are active ingredients in a process in which both stock prices and the fortunes of the company whose stocks are traded are determined. So two things are always important to be noted. Market participants' views, basically the investors' views, are always biased in one way or the other. Second is that market can influence the events that they anticipate. For example, a recession. So then here Soros is introducing two concepts. Concept of prevailing bias and concept of underlying value. So first, concept of prevailing bias. If you see, the market participants have got lot of views. So there will be a set of views which is in one direction, and another set of views which are in other directions. And these views of individuals cancel out with each other, and a prevailing bias remains. So this prevailing bias can be of two types: positive bias and a negative bias. Positive bias can lead to a rising stock price, and a negative bias can lead to a falling stock price. Next concept is the concept of underlying value. This concept of underlying value influences the stock prices whether the participants or the investors understand it or recognizes it or not. Influence on stock prices may vary based on the view of the market participants. So whatever we call as a trend in the stock market is based on these two concepts: the prevailing bias and the underlying value. The trend is resultant of these two concepts. So a trend can be a positive trend, a negative trend, a consolidation trend, etc. So all of this is based on the resultant of the prevailing bias and the underlying trend. So as explained in the reflexivity theory, both this prevailing bias and the underlying trend interact with each other. They have a reflexive relationship. The underlying trend influences the participant's perception through the cognitive function, and the resultant change in participant's perception affects the situation through the participating function. So remember our cognitive function and the participating function which we had learned some time back. So in our stock market, the change in stock price will be the primary impact, and the change in stock prices may in turn impact the prevailing bias and the underlying trend. So we have three variables here: the stock price, the underlying trend, and the prevailing bias. So in stock market, in a typical sequence, the three variables, the stock price, the prevailing bias, and the underlying trend, reinforce each other, first in one direction and then in another direction, in a pattern which is best known as the boom and bust cycle. So boom in the sense the upward trend of the stock, and bust in the sense the downward trend, and there is a point wherein the trends change. So that's the midpoint. So when the stock prices reinforce the underlying trend, we call it a self-reinforcing trend. And when the underlying trend works in opposite direction, then it is called a self-correcting trend. Same applies for the prevailing bias as well. Self-reinforcing prevailing bias and self-correcting prevailing bias. So if you see, when a trend is reinforced, it accelerates. And when a bias is reinforced, the divergence between the expectation and the actual course of future stock price gets wider, and conversely speaking, the divergence narrows. When the prevailing bias helps the stock price, it's called a positive bias. And if the prevailing bias goes against the stock price, then it's called a negative bias. Thus, the rising prices are reinforced by positive bias, and the falling price is reinforced by negative bias. So in a typical boom and bust cycle, or in a sinusoidal stock market price curve, we can expect at least one stretch wherein rising prices are reinforced by positive bias, falling prices are reinforced by negative bias, and another point wherein the prevailing bias and the underlying trend combine to reverse the trend in the stock market. So that's a midpoint. You have a upper circle, positive bias, you have a below circle, negative bias, and the midpoint wherein it is crossing the midline is the point which I mentioned here. So as I mentioned earlier, the fundamentals include earnings, dividend, free cash flow, asset value, etc. So it is possible to have a reflexive connection between the stock prices and the prevailing bias, even if the fundamentals are unaffected. So without fundamentals involved, the fluctuation would be very short-lived, like what we see in day-to-day stock market. The prices go up, down, etc. on a very short duration. It would be a big mistake to ignore these biases as near-term market noise, as stated in the theory of perfect competition and the fundamentalist approach of security analysis. Because when the fundamentals are affected, these biases cannot be left out without serious distortion in the stock prices. Because the bias gives rise to self-reinforcing process which neither leaves the stock prices or the view or the perception of the investors same as that of before. If you see, the participants' perception of the fundamentals are bound to be flawed. These flaws may not be identifiable at the early stages, but someday or the other it is supposed to surface, and once this surfaces, this reverses the prevailing bias. And if this change in bias reverses the underlying trend, a self-reinforcing process is set in motion in opposite direction. I know that whatever concepts I mentioned here and the reflexivity theory which I mentioned and all the concepts which I explained here are really complex and you may take some time to understand. I suggest you to go through this video at least 3-4 times to understand the complete concept. Take a book and pen and write it down, and you can always ask the questions if anything is there with you. So the key here is that to understand what is the flaw and when it will manifest, and this is the key to understanding the boom and bust sequence. So to conclude, the reflexive model can never replace or take the place of the fundamental analysis, but definitely the reflexive analysis can be a missing component of the fundamental analysis, in the sense you have to do all the fundamental analysis like the cash flow statement analysis, the free cash flow, then the earnings potential, then the cash available, then the future projections, etc. But in addition to that, you have to do a reflexive analysis as well. As you all know, the fundamental analysis seeks to establish how underlying values are reflected in the stock prices. And in turn, the theory of reflexivity or the reflexive analysis helps to understand how the stock prices are influencing the underlying values. So it provides a dynamic partner to the fundamental analysis. In coming sessions, I am going to upload a video wherein all the sequences in the reflexive analysis, starting from the bias identification, then the trend identification, and how this will surface and impact the stock prices, will be sequentially noted down and it will be explained in detail. You should always note that you cannot avoid fundamental analysis, as George Soros also explains. Please don't mistake George Soros as a trader. He is also giving full respect and due diligence and due importance to fundamental analysis, but he also brings in the impact of the market participants thinking in the market situation and how it will impact the stock prices, and he is also factoring that in. And this, along with the fundamental analysis, will really help you to track or to enter a stock and to exit a stock. Hope this video was really informative for you. If you have any questions, please feel free to comment in the below comment section. See you in the next video. Till then, happy investing.